OG John AG here. The silver market has just experienced an explosive surge, catapulting 22% from the low established just yesterday. We've moved from $65 all the way to $78. The global spot price for silver reached $77.16 per ounce, representing an increase exceeding 20% from its recent bottom. Silver has ascended by 22%, decisively recapturing the $78 level. Meanwhile, Bitcoin has powered upward by $11,000 within the last day, reclaiming the $70,000 threshold. The cryptocurrency market capitalization swelled by $340 billion today alone. In an astonishing parallel move, over $1 trillion in value flooded back into the U.S. equity market in the past 2 hours, with the Nasdaq and S&P 500 completely erasing yesterday's severe decline. The Dow Jones Industrial Average has skyrocketed by 950 points, achieving a brand new all-time high. At this moment, as I record, the prices are as follows. Western spot silver is at $78, while the Shanghai spot price stands at $82. A crucial message for new audience members: this platform has never and will never solicit money from you in any shape or form. Any individual attempting to do so while using my identity is engaging in fraud. This channel is built upon a foundation of factual scrutiny and genuine analysis, not recycled sensationalism that imitators are peddling. If your preference is for exaggerated, hyped-up commentary, I suggest you seek out those copycats who will twist my statements to fit whatever story serves their purpose. They will proclaim it's time for prices to moon when the charts are green, and prophesize doom when they are red, whatever it takes to keep you engaged. My team and I examine both optimistic and pessimistic factors using verified information, because that is the authentic nature of financial markets. It is genuinely amusing to observe them offering guarantees of certainty within an inherently uncertain trading environment. I operate exclusively under the handle OG John AG on both YouTube and X. Now let's refocus on the breakdown, because this endeavor is not about making predictions. It is about comprehending price behavior and underlying fundamentals. Silver plunged to $65 yesterday, marking the lowest point of this corrective phase. Presently, it trades at $78. That constitutes an approximate 22% upswing within a 24-hour window. You might have missed this dramatic shift if you rely solely on mainstream financial news, but the reversal is extraordinarily forceful, and it is occurring across all risk-sensitive assets at the same time. Bitcoin has gained 17%, surging $10,000 from its recent lows. Ethereum has rallied 18%, recovering the $2,000 level after touching lows near $1,750, with $550 million in short positions being liquidated. Over $304 billion has been injected into the crypto market in the last 20 hours. The Russell 2000 index is up 3.1% today, contributing nearly $100 billion in market capitalization. It has fully recovered from yesterday's sell-off and has turned positive for the week. This activity demonstrates investors deploying capital into assets with higher risk profiles. Small capitalization stocks are reacting more swiftly than their large cap counterparts. An analogous trend is visible in cryptocurrency. Bitcoin declined nearly 35% over the preceding 3 weeks, falling from $90,000 to approximately $60,000. Yet, during that identical period, altcoin valuations measured against Bitcoin, BTC pairs, increased by roughly 11%. This reveals underlying strength in higher beta digital assets, even while Bitcoin was weak. The pattern is unmistakable. Equities, precious metals, and cryptocurrencies are crashing and recovering virtually every single day. The same sequence repeats over and over throughout 2026. Eventually, you cease labeling it mere volatility and begin identifying it for what it truly represents. Markets are subject to manipulation. News narratives are manipulated. Historical context is manipulated. However, the underlying truth cannot remain concealed indefinitely. Now, we arrive at the pivotal question. Did the chief of metals at JP Morgan call the bottom in silver? The commentary notes, corrections do not terminate bull markets. Blind consensus does. The silver lease rate in London has jumped to 6.1% for 1-month contracts. That metric alone communicates everything about the recent crash. This was a flushing out of leveraged paper positions, not a collapse in tangible physical demand. If supply were abundant, institutional players would not be paying a premium to borrow silver at this moment. A 6.1% lease rate signifies physical metal is scarce and becoming scarcer. The silver SEO index now sits at 106.35 and continues to climb. Silver also remains in a state of backwardation. What is the consequence when the silver price is artificially suppressed? Physical inventory vanishes from the market. Exchange open interest data provides a significant signal. As of Thursday, with gold establishing a higher low compared to Monday, the total open interest in COMEX gold contracts plummeted to just 400,952 contracts. This is the lowest daily total recorded since December 14, 2018, down sharply from a recent high of 555,309 contracts merely 2 weeks ago. What is the implication? As speculative traders first trickle and then rush back into the market, open interest will expand once more alongside price. Although daily price fluctuations will continue, the lows are highly probable to already be established, and prices will generally trend upward in the coming weeks. Stockpile data from Chinese exchanges shows silver inventories are plummeting. Since 2020, approximately 6,600 tons of silver have been drained. This represents a 90% drawdown over 6 years, a quantity equivalent to 30% of annual global silver supply. Physical silver demand within China remains powerfully strong. The Shanghai Gold Exchange, SGE, plus the Shanghai Futures Exchange, SHFE, hold a combined total of approximately 850 tons. Following today's withdrawal of roughly 73 tons, just 11 more days of similar outflows would leave these vaults completely empty. Chinese purchasers are utilizing lower prices to accumulate silver aggressively. SHFE and SGE silver vaults continue to decline to fresh record lows, a situation amplified by China's status as the world's largest consumer of both gold and silver. This scenario has the potential to push the global gold and silver markets into a severe, uncontrolled state. The geopolitical situation involving Iran is escalating. Iran has refused to terminate its nuclear enrichment program during talks with the United States. The U.S. announced new oil sanctions targeting Iran immediately after the discussions concluded. Iran declined to provide an opportunity for the U.S. administration to save face and reach an agreement. Subsequent developments may prove significant. A geopolitical risk premium is returning to financial markets, which traditionally provide support for precious metals. If you are feeling panic about silver at this juncture, you are observing the incorrect time horizon. Drawing a long-term regression trend on the price of silver, divided by the U.S. M2 money supply from the mid-1980s onward, the recent rally breached a long-standing historical range. The current pullback may appear substantial on a daily chart, but on this long-term chart, it is merely a retest of that recently broken range until proven otherwise. Critically, the price has not even surpassed the extreme high from 2011, yet some commentators are already dismissing silver's potential. The precise timing may vary, but considerable momentum remains for this overarching move. Perspective is paramount over short-term noise. So is common sense, which, incidentally, is even rarer than physical silver. Did you genuinely believe this ascent would be a straight line upward? This is one of the most significant financial contests in human history, and major contests are never straightforward. However, if you concentrate on fundamentals and apply reasoned judgment, the psychological strain becomes far more manageable. True strength is derived from understanding. Silver mining companies are positioned for an explosive performance in 2026. Silver recently surged into triple-digit territory, hitting over $120 before retracing to around $70 presently. Yet the authentic narrative is that the mining equities have scarcely kept pace so far. This is the classic leverage play. During the 2002 to 2011 bull market, silver itself rose approximately 300%. A leading silver miner, Pan American Silver, skyrocketed by 1,500%. That represents a gain 5 times that of the metal. On average, silver mining equities typically deliver 3 times the movement of the silver price. What transpired in 2025? Silver prices ripped dramatically higher, posting massive gains. But silver mining equities, as tracked by the SIL ETF, lagged severely, barely matching or even underperforming physical silver at times. Why? Analysts were still evaluating these companies based on outdated $35 to $40 silver price assumptions, looking through the rearview mirror. The trigger for a 2026 turnaround is imminent. Major mining firms begin reporting earnings this very month. Producers will reveal explosive cash flow generation. For example, a producer generating 10 million ounces annually will report profit figures roughly 1,200% higher than in earlier quarters when silver prices were significantly lower than current levels. The market cannot ignore numbers of that magnitude. Analysts will be compelled to upgrade their valuations rapidly. There is a precedent in the gold mining sector. Gold climbed from $2,300 in 2019 to recent highs around $5,500. Numerous gold miners lagged initially but then experienced powerful rallies. Examples like Agnico Eagle, which moved from $40 to $300, illustrate this. Silver miners have also lagged behind gold miners, but the catch-up phase is now commencing. According to Bloomberg, major banks do not possess infinite balance sheets for trading precious metals. This is a structural constraint. They cannot suppress the price indefinitely using unlimited paper contracts. The limits of their balance sheets are a real factor. When tangible physical demand overwhelms the available paper supply, a dramatic repricing occurs. Now, the timeline for the impending COMEX March crisis. We are 21 days away from a scenario where 429 million ounces of documented demand meets 103 million ounces of reported supply. An analysis of the data reveals precisely why the COMEX silver market appears on the verge of breaking. If the delivery rate matches the intensity seen in January and February, between 50% to 70%, we are looking at demands for 200 to 300 million ounces standing for physical delivery against an available inventory of only 85 to 103 million ounces. The core problem as of February 5th, 2026 is this: March 2026 open interest, 429 million ounces. COMEX registered silver inventory, 103.5 million ounces and declining. February 2026 delivery rate, 98%, 18.72 million ounces delivered from 19.11 million ounces open interest. Inventory drainage rate, 785,000 ounces per day. January 2026 deliveries, 49.4 million ounces, 7.27 times the level seen in 2024. If the March 2026 contract month sees even 25% of its contracts stand for delivery, the COMEX would need to supply 107 million ounces. This could potentially exceed what will be available by the first notice day on February 27th. Should the delivery rate match the January-February intensity of 50% to 70%, demands for 200 to 300 million ounces would stand against only 85 to 103 million ounces available. Is the long-anticipated COMEX silver default now only 3 weeks away? However, a candid risk assessment is necessary. Historical patterns suggest there may be additional downside ahead for Bitcoin. Every major Bitcoin bear market over the last 14 years has witnessed drawdowns of at least 75% from all-time highs, lows of 93% in 2011, 84% in 2015, 83% in 2018, and 76% in 2022. A polynomial trend analysis shows each successive bear market bottom becoming shallower, but the next projected trough still points to approximately a 70% decline. Applying this to the current drop, a 70% drawdown would imply a Bitcoin price near $38,000 this cycle. The silver-to-gold ratio has been tracking Bitcoin directionally. For silver and gold to stabilize and recover, a pause or basing period in Bitcoin is crucial. As long as BTC remains under pressure, downside risk for the metals persists. Bitcoin is the canary in the coal mine for this risk-off movement. Therefore, while silver has rebounded 22% from $65 to $78, Bitcoin has reclaimed $70,000, and risk appetite has returned violently today, Bitcoin's technical structure suggests more volatility is possible. This does not mean the bottom is not in. It means we require further confirmation before declaring an all-clear signal. Consider this perspective on technicals. In mid-December, silver was at $65 with the RSI near 80 and universal bullishness. Now we are back at $65, but the RSI is at 30 and market sentiment is bearish. The price level is identical, yet the prevailing psychology is completely inverted. Does this guarantee we have found the bottom? No. Markets can remain oversold longer than anticipated, particularly during deleveraging events. The 47% crash unfolded across just 7 trading sessions, illustrating how rapidly sentiment can transform. Violent downward moves often precede violent upward moves, but the key term is often, not always. Gold's long-term parabolic structural setup remains intact, suggesting the broader precious metals bull market is not broken. But silver needs to hold current levels and construct a base before we can confirm this as the low, rather than merely a bounce within a larger correction. Nevertheless, structural indicators point to an exhaustion of selling pressure. COMEX gold open interest is at its lowest since December 2018. The silver lease rate is 6.1%. Backwardation continues. Chinese vaults drained 73 tons in a single day. At this rate, they are 11 days from empty. Registered COMEX silver stands at 103 million ounces versus 429 million ounces of open interest exposure. We are 21 days until the March 1st notice day. The February delivery rate was 98%. These are not indicators of abundant supply. These are hallmarks of paper leverage being flushed, while physical conditions grow increasingly tight. 3 key takeaways. 1. Silver has rocketed 22% from its $65 low to $78. Bitcoin gained $11,000, reclaiming $70,000. The crypto market added $340 billion today. U.S. stocks added $1 trillion in 2 hours. The Dow reached a new all-time high. The Russell 2000 added $100 billion and fully recovered. The return of risk appetite has been violent and rapid. $550 million in short positions were liquidated. Dip buying has been aggressive across all asset classes. However, Bitcoin's technical structure suggests a 70% drawdown is historically normal, potentially implying a $38,000 target. More volatility is possible. Confirmation is required before definitively calling a bottom. 2. The silver lease rate of 6.1% indicates this was a paper leverage flush, not a collapse in physical demand. The SEO index at 106, ongoing backwardation, and COMEX gold open interest at its lowest since December 2018 all signal that speculative long positions will rush back in. Open interest will expand alongside price. The lows are likely established. Chinese vaults drained 73 tons today. At this pace, they are 11 days from empty, a 90% drawdown since 2020. Chinese buyers are accumulating aggressively during weakness. The long-term silver to M2 chart shows a retest of a broken range, not a reversal of the bull trend. The price hasn't even crossed the 2011 high yet. Maintain perspective over noise. 3. The COMEX March crisis is 21 days away. Open interest stands at 429 million ounces versus 103 million ounces of registered inventory. The February delivery rate was 98%. January deliveries totaled 49 million ounces, 7 times the 2024 level. The daily drainage rate is 785,000 ounces. If March sees a 50% to 70% delivery rate, demand of 200 to 300 million ounces will face a supply of only 85 to 103 million. Silver miners begin reporting earnings this month, revealing explosive cash flow generated by higher prices. Historically, they offer 3 times the leverage to the metal's move, with some gaining 1,500% in prior bulls. Analysts will be forced to upgrade valuations. Bloomberg notes banks lack infinite balance sheets to trade metals. Structural limits are real and consequential. Unresolved tension. Did we just witness the definitive low at 65 with a 22% bounce confirming the bottom? Or is this a relief rally before Bitcoin completes its historical 70% drawdown pattern, potentially dragging silver lower once more? COMEX open interest at its lowest since 2018 suggests speculators have been washed out. Lease rates at 6.1% signal physical tightness. March delivery mathematics point to a shortage. Yet Bitcoin correlation and historical bear market depth suggest more downside remains possible. The next 3 weeks will determine whether the impending March delivery crisis forces a dramatic repricing or if broader deleveraging continues. The data will provide the answer. Presently, structural tightness is extreme, but technical confirmation is still developing. Conduct your own due diligence. Understand the risks. Bitcoin may have further downside per historical patterns. Volatility is likely to continue. However, COMEX registered inventory is 103 million ounces against 429 million ounces of exposure. March is 3 weeks away. Chinese vaults are 11 days from empty at the current drain rate. Lease rates are at 6.1%. A powerful bounce of 22% has occurred from $65. Risk appetite is returning. Know your investment time frame. Invest using logic, not hype. Base your decisions on rigorous analysis, not fleeting emotion. OG out.